Hey guys, how's it going? Welcome to this live broadcast, and it'll be archived, so you can definitely watch it later. We're going to kind of go through some multi-factor models as well as a pretty fun R model walkthrough. I think it'll be pretty cool just to give you guys a glimpse of how to build a multi-factor model, what a lot of investment managers do. Frankly, that's what's the industry is going towards these days. For example, BlackRock just got rid of a lot of their kind of fundamental qualitative portfolio managers, and now they're predominantly quantitative. So they're running a lot of multi-factor quantitative models. So I'll give you a kind of behind the scenes look on how to build those, which is pretty neat. So first off, I will have to chat up so we can kind of go back and forth here and there as well. So if you have any questions, feel free. The model that I'm going to go through at the end is not the model I use. The model I use is a lot more robust, a lot more factors. The code I use is a bit more condensed. What I'm using here for the walkthrough, I kind of made it more easier for you guys to follow through, especially if you haven't had much experience in R. So it's a little clunky, but I think it's a bit easier to walk through and see what I'm doing. So, first off, I kind of want to give you an intro to kind of what a multi-factor model is. But first, definitely follow me on Twitter, at CryptoQF. I'll be updating the quantitative model pretty much every day. I try to. I have a master link on my page where the Google Doc is, so you can definitely check it out and see how it's doing and see what the model likes and dislikes. YouTube. This is, I guess, I would consider an educational video, so it's a bit more boring, but that's okay. And that's what's amazing about this crypto community is there's actually people watching me go through R code. That's literally amazing to me. In real life, quote unquote, basically nobody would give a shit. So it's awesome that there's people that actually care about this in crypto, which is great. Also have some funny videos and some fundamental analysis. For example, I went through the VanEck, SolidX, CBOE presentation deck for the SEC. That's a video out there. And plus some, quick rapid fire buy, sell, hold from the Quant model. So definitely keep an eye on that stuff. So what is a multi-factor model? So for those of you that are in school, out of school, have done some financial stuff, you probably have seen this in some way, shape, or form. So up top, you got the capital asset pricing model, and the bottom, you got the arbitrage pricing model. A lot of it's kind of the foundation of really modern finance in a lot of ways. So the capital asset pricing model up top, I'll kind of walk through the formula. I'll try to keep it high level as possible. What it's saying is on the left-hand side, RA, which is basically the expected return of a stock in this case, is equal to RF, which is interest rates, which let's just assume the risk-free interest rate is zero for this case, plus the beta times RM, which is the market. So the beta times RM. So what does that mean? Well, basically, the riskier the stock, the more it's going to return. So when somebody says, beta of 1.1 and the market returns 10%, the stock is expected to return 11%. If the beta is 0.9, the market returns 10%, the stock's expected to return 9%, excuse me. Pretty simple from the 1960s. We've kind of come a long way since then. The arbitrage pricing model down below is really the foundation of multi-factor models, which is what I'll get into in a little bit. So what does this say? Well, it's very similar structure to the CAPM, except it's adding a lot more terms. So the expected return of a stock, or in our case, a crypto, is equal to the risk-free rate, which we can ignore here. But then it has a bunch of terms. You see beta 1 times RP1 plus beta 2 times RP2, on and on and on and on. So what this is saying is basically, in layman's terms, how exposed is a stock or a crypto to a singular, what I'll call factor. So how exposed is a crypto to momentum? Or how exposed is it to valuation or reversals or liquidity or whatever it might be? So when I talk about exposure in this case, if we have 200 or 300 cryptocurrencies lined up in a row, the one that has the most exposure would have the biggest number. The one that has the least exposure would have the lowest number, a negative number. And that's at current time 0, like right now, for example. Then RP is basically how powerful is that factor. So just kind of keep going with that example. We have all 200 or 300 coins lined up. We find out which ones have the most momentum, which ones have the least momentum. But through a lot of statistical testing, we basically see how strong momentum is. What does momentum mean in terms of adding value to expected return? And then you have the plus term. So you might have, let's do the same thing for value, do the same thing for reversals, liquidity, so on and so forth. I don't want to just focus too much on this because I don't want to act like I'm a teacher, because I'm not, but I think it's good background. So I think the reason why this is really important and really cool is we've seen a lot of research, a lot of academic research over the past 20, 30 years on these factors within these multi-factor models. So nothing I'm doing here is new. I'm doing it new in crypto, but not, the concept isn't new. So people have found value factors that have added value and predicted future outperformance, underperformance in US equities, international equities. You can see all the names and corresponding papers here. FCC is basically commodities and currencies. So the gist of it is value adds, quote unquote, value in equities, in commodities, and currencies. Momentum works in equities and commodities and currencies. Having a lower risk profile works in equities, commodities, currencies, so on and so forth. So these things work literally everywhere. So the question is, well, would it work in crypto, which I'll get to in a few minutes. So what does this mean by adding value or quote unquote working? So this is just a snapshot of what that means and some historical research that people have done. So this is just on US stocks. So take the low risk factor, and the paper here, Frazzini and Peterson 2013 defined it as stocks with low risk versus high risk, whether you're looking at beta, volatility, or idiosyncratic volatility, which we don't need to get into. But the period they looked at was 1926 to 2012. What they found is low risk stocks outperformed by 8.73% annualized, so, basically every year on average. And with a T-stat for those with a statistical background, this is how we determine if the annual premium in this case is legitimate, is different than 0 or not different than 0. How confident are we that the actual premium is different than 0? In this case, a 7.12 T-stat is enormous. Basically, it depends who you're talking to, but you can have 1.65 is pretty reasonable, 1.96. Anything over 2 is definitely pretty legit. So 7.12 is very high. So very confident that low risk adds value in US stocks. When you look at size, same thing, 3.54%, that low market cap stocks beat high market cap stocks. Same thing with value, momentum, profitability, investment. And if you look at momentum, that's pretty big in crypto, but the way they define it, at least in academia and most equity managers, they look at 12 months minus 1 month. So what does that mean? That just looks at the return of basically the 11-month return before the previous month. That makes sense. The reason why they exclude the previous month is due to a reversal factor, which I actually have in my model. So you'll see that in a little bit. So I got a few comments on the chat. Thanks, guys. I'll say something too. I'm still getting used to this YouTube. So why do these factors work? That's a fundamental, important thing you always have to ask. And you can't go any further in any sort of quantitative research, or frankly, I'd even say technical analysis or even fundamental analysis, if you don't have a rationale or a reason why that factor, that research, or that indicator might work. If you don't know why it might work, whether you have an economic reason, a risk reason, a behavioral reason, then you can't go any further. If you just data mine the heck out of it, you could probably find anything anywhere, but you got to have a foundation in terms of why something might work. So these are various factors. Again, I put here risk, momentum, value, growth, quality. There's a bunch. How to capture. So these are equities. My background is primarily in equities. I manage equity portfolios for a living, and some multi-asset class portfolios as well. So I literally build these things kind of day in, day out. But the key is, why do they work? And here you see risk-based theories, which is kind of economic reasons, and behavioral theories. So for example, risk, you see why it might work on a behavioral theory. You have lottery effect, or overconfidence, or loss aversion, or momentum. You have under or overreaction, something called herding, which means it's basically FOMO in crypto terms. So you have a variety of behavioral reasons, why these things work. So that's kind of my intro here. I think kind of keep moving in, and I'll jump into R in a second. But the big question here is, do they work in crypto? And there's a great paper out there by Cliff Asness called Value Momentum Everywhere. And he's the one who basically found that value momentum also work in a variety of asset classes, including commodities, currencies, et cetera. And the key thing here is, they actually work in crypto, which is as expected. Now, I don't know of anybody else that's done a multi-factor model in crypto. I think I might be the first. But, I found a lot of these same factors that work in stocks, that work in commodities, that work in currencies, that work in equity indices in crypto. So whether it's momentum, lower volatility, lower risk, liquidity, reversals, value. So the same theories that apply in traditional markets really apply in crypto. Now, crypto is a lot more quick, fast moving, a lot more volatile. So there's obviously some nuances, but really the same concepts apply. So if you have a good background, good foundation in traditional markets, it kind of make a transition relatively easy, in my opinion. But I'll actually be hopefully writing a paper detailing some of these factors to kind of give those who care a bit more color. So anyways, I'll jump into R now, which is probably why most of you are here. So if you have any questions, feel free to write in the chat, or you can feel free to direct message me on Twitter. I'll be there, or even later on YouTube. That's fine too. But I will jump straight into kind of the R code here. I actually wrote this model for you guys as I was on vacation over the past week, and we had a 10-hour drive, and somebody else was driving, so at least half of it. So I quickly wrote it. So it's a little clunky, but I think it'll be a decent model that you guys can kind of walk through and see what I'm doing in kind of real life. I condense a lot of this code. It actually runs a lot faster, but it would be a lot more difficult to follow along. So here I actually say 3-factor model. It's really a 2-factor model. My bad. So I will change that real quick. So what I'm doing here is I am testing 2 different factors here. One would be a reversal factor, which I'm just using a very simple one-day return. So what happened yesterday, and then a momentum factor, which I'm defining as 2 weeks minus 4 days. So the reason why I picked 4 days is pretty, there's a distinct reason. A lot of my research kind of shows reversals in crypto is generally around 4 days long. So to kind of get into the momentum period, kind of have to go back a little bit further. So like I mentioned here, I'm keeping it pretty simple. There's some steps I definitely will skip that you would not want to skip. So if you're building a real model one day or doing it for school or whatever you might be doing, feel free to DM me. Like for example, I'm not really cleaning the data as good as I would and certain things when I run the regressions I'm not doing, like for example, doing weighted regressions here. I'm not using weighted regressions. So, and then also we will get into kind of model returns at the end, kind of blasting out some disclaimers. What I'm doing here would be what I would consider a in-sample back test, or like a fake back test, as in we will be seeing what the model would have done in the past given the knowledge that we have today, which of course doesn't really make sense in real life. So if you follow along on my Twitter, you can see my multi-factor model. I have some historical performance. That is all 100% out of sample, as in, I have built kind of some dynamic second layer models in there. So it's truly what would have happened on that day. There's no hindsight in any of my models, but we do have that here. So just to keep that in mind. All right, so we will just jump right in. If you have any issues with the code, just jump in. And also in terms of R, I use RStudio, which is just a kind of interface. What you can do if you don't have R, it's open source, it's free. Just go to the R project and you can download it there. And then I use RStudio. So after I download R, I just go to RStudio. It's another website and you can just download that there. It's pretty straightforward. And then basically this screen will pop up, excluding the code you have that in front of you. So I already have some data that I've accumulated, which we're not going to get into necessarily how I got the data or anything like that. That's a big project in and of itself, finding all the data. So what I'm doing here is I'm just grabbing the data here in a new data frame called alt data, and then I'm making a copy called alt coins, which will pop up in a second. So I'll show you what that looks like. So here we have data. So this is Bitcoin. And you can see down here, hopefully, it says 860,000 entries. So that's how many lines we have here. So all I have here to do this basic two-factor model that I'm going to do, I just need date, I need close, then I have some constraints, so I want volume as well. You can see the price here for Bitcoin in 12/27/2013, the volume. I can scroll down. I'll just pick a random spot. Doesn't really matter. Here, line 440,000. We have BitBar, whatever that might be. There's no volume here. So basically, either way, we have data on pretty much all coins out there. That's where we're going to start it. All right, I'm going to bounce back to the model. Okay, I got a couple questions here. So where do I get the data? That varies. There's just some packages out there in R, plus some kind of just doing stuff by hand. I can definitely get into that, offline at some point. But some exchanges, have APIs you can tap into. So it's tricky in terms of pricing data and volume data. That's the easiest to get. But once you try to get into deeper stuff, that's where it gets tricky. But the beauty is now, we at least have 5, 6, 7 years of pricing data and volume data. So now we actually have a big enough sample size to do some quantitative stuff. And the next question, do I work with daily intervals? Well, yeah, generally, I would say most of my data would be daily, but not necessarily all of it. So, for example, I'm building a kind of Bitcoin in or out type model where I'm using kind of real-time Google Trends data. So it's not all purely daily, but a good chunk, and pretty much everything in this model I'm demonstrating here today is daily. Now, like I mentioned, one factor I'm using here is 2 weeks minus 4 days. So, I'm building the 2-week return and the 4-day return with daily data. I didn't start with either one, and I'll show you how I build that return. But it's using daily data to build that. Yeah, data science is definitely a data collection. That's the tricky part, honestly. Like building this model is kind of the easy part. Getting the data is honestly the more difficult part. So actually, I'm doing something else too. So besides a volume constraint in the model, I'm going to have a what you consider how long the coin's been around constraint. So I don't want any coin to enter my model if it's only been around for about 4 months. If it's been around for 4 months or less, I don't think necessarily there's enough data. Could be, exchange pump, who knows, just kind of quirky data. So I don't want it to be my model. Once it gets beyond 4 months, it can be in my model. So, what do I have here? I'm sucking this into R. And I'll show you what this is. So inception date, this is kind of lingo in finance, but basically when I first get data for each coin. So here I just have one line for each coin or token. I have 1,885 entries. So that's how many coins or tokens I have data for. And you can see the variety of inception dates. Some of them are very recent. In the last 13, Able, which was just on August 24th. And then you have some that are much more ancient, but they don't really do much anymore, like 42 coin. So that's from 2014. So it varies, but either way, I have this data as well, and that's another constraint we're going to have in the model. All right, so basically when I just wrote this, I plugged in a couple of dates, kind of random, but I'm using August 26, 2018 as kind of my start date. Depending how you want to define start or end dates, I might have it backwards for the way your brain might think. But my end date here is January 28, 2015. So I'm actually working backwards in this model. And then I have something called RD here. And if you have any questions on code, I'm happy to kind of go into it. The RD is, for me at least, it's an acronym for the return date, which is the start date plus 1. So what we're going to be doing is we're going to be running some regressions. And the regressions are going to be looking at various exposures for coins for those two factors I mentioned before. So the 1-day return and the 2-week minus 4-day. So basically, which coins have the best 1-day return, which ones have the least, that'll define their exposure. We're going to run a regression with those as our independent variables and see if we can predict the next day's return. And that's what RD is. So I'm going to be grabbing the next day's return. So that's why it's SD plus 1. So the exposures, for example, the 1-day and the 2-week minus 4-day is going to be, call it times 0, which is SD, and the RD is times 0 plus 1 the next day. And then I have something called SD loop and RD loop because I wrote a couple very clunky loops here to get the data. In real life, I use databases or you can use CSV files. Doesn't necessarily matter, but it's a lot faster doing the data collection and running the model that way. But here I just did everything in R just to kind of show you guys exactly what's going on. So I'll have to keep track of what I'm running. And then line 84, I'm actually changing a date format, which I'll go back to all coins here. You can see it's like, you can see the format here. I'm just switching it from the backslashes to just hyphens. So I'll run that. Pretty simple. Obviously, I'll be nervous if something breaks, which could happen. All right, so basically, for those that don't know R, what I'm doing up top is kind of, it's where I like to write my code up here and then just click run, and then it runs down below in the console. But you can also write the code down in the console. There's a lot of different ways you can do it, and that's the beauty of R. There's honestly hundreds of ways you can do the same exact thing, which is awesome. Somebody asked me before, how do you learn R? Honestly, I mean, there's some classes on Coursera you could take, but for me, the easiest way is just to download it and just start. Especially if you have some Excel skills, I think that's a great start because you can build something in Excel. You know what the answer is supposed to be, and then you can try to mimic it in R, and you'll get there eventually. And you'll kind of match answers, and then you'll be like, "Oh shit, I know what I'm doing." And that's frankly a lot of how I learned in the past. And then also Google's your friend. R has a lot of what they call packages, or you can have like custom functions. So if you don't necessarily know how to do something, you just hop on Google, and somebody's probably already done it. So it's pretty straightforward. So what I'm doing now, 87 through 98, is I'm getting rid of some stable coins that will kind of skew my data. So what this line of code is doing is looking for the name. I'll talk through 92 since it's better, and we all know that. It's looking through the all coins database in the name column, which I'll go back here. You have the name column here, and that's saying remove anything that has the name Tether in it. And also these other stable coins. There's, this is some of the crappy data collection I was mentioning in the chat before. And I just have to keep up on what's a stable coin. There's some judgment here, like for example, Steam dollars. Some might not consider it a stable coin, but it actually pumped up pretty good in December, January. But it kind of does behave very much like a stable coin as well. So I excluded it. So I will run that line of code, and you can see below it's just popping through in the console and executing. So now if I went to all coins here, there wouldn't be a tether in there anymore. All right, so next I'm doing is will this be recorded? Yes, it is recorded, so it'll be on my YouTube channel. Will it be on GitHub? Maybe, I don't know yet. I mean, this is pretty basic model, so I'll be pretty happy to share this. My proprietary model, the one I'm going to write a paper on and all that stuff, I probably won't have that open source to code, at least until I write a few more things. But you can always see the results every day. So on 101 and 102, what I'm doing is getting the monthly volume. So another constraint I have is I want to get rid of super illiquid coins. Like I mentioned before, in this inception date tab, I have 1,800 coins. A lot of them have no volume. So I'm going to have a constraint. So the first thing I'm doing here is I'm basically getting the median, which is not quite the average, but or the mean. I guess median is technically an average. But if you have, say, 9 data points, the median would be, if you ranked them, would be the 5th. So what I'm doing is I'm finding what's right in between. If you rank these 30, the last trailing 30 days. And I'll show you how this actually works in a second. But the reason why I'm not using mean is pretty simple. If a coin has a major like pump and dump, volume can really explode for a day or two, but it's kind of fake volume. So here I'm trying to capture kind of consistent volume. So I'll run that code again real fast. And I'll pop back over to all coins. So now you can see month average volume. So it's actually not going to kick in until 30 days. So you can see a bunch of NAs and then here. So now I have my kind of 30-day median of volume, and it just keeps going and keeps going, keeps going, and keeps going. So that's pretty straightforward. And then next I'm going to do is get those returns I've been talking about. So the last 1 day return, the last 2 weeks minus 4 days, and tomorrow's return. And there's actually a lot of ways to do this. And the way I'm doing it here, I think it is probably the easiest way for people to see what I'm doing. So lines 106, 107, 108, I'm basically sliding what they call the close column. So here's close. So here's the end of day close for Bitcoin on each of these days. So I'm sliding it. So I will show you what that means in a second. All right. So I ran that. There we go. So take a look at close -1. See my cursor. You have 73.5 $735 on the state. The state is actually, it's the previous day's close. See here how they actually line up. And then same thing with close -4, it's the close from 4 days ago. And 14, it's the close from 14 days ago. So I'm just lining it all up on the same row. That just kind of makes some of the math easier and should help you guys if you want to follow along or build something eventually. So now I'm actually going to get the 1 day return, 4 day return, and 2 week return, and the 2 weeks minus 4 day return. So this is pretty straightforward to the 1 day. So I'm taking the close of today, basically, minus the close from yesterday, that close -1, divided by the close minus yesterday. So how much did the coin appreciate, depreciate, close to close? And then the same thing for 4 day and 2 week, and then 2 week minus 4 day, I'm just subtracting them out. So I'll show you guys that in a sec. Oops. And as you can see, the stuff runs instantaneously. So here, I got all these new columns here, 1 day return, 4 day, 2 week, and 2 week minus 4, which we don't necessarily need to get into, but now I got those. Okay, I got a couple more questions. So don't the tether pairs tend to perform better? So everything I'm doing here is in USD terms. The reality is whether I do it against BTC or USD or Euro or Yen or anything, it doesn't actually really matter in this case, because what I'm going to be running is what they call cross-sectional regression. So going across all coins at a specific time. So what the denominator currency is, whether it's Bitcoin, US dollar, whatever it is, actually doesn't necessarily matter, but everything here is in US dollar terms. And then what that means, actually, interpretation, is this model, the one we're building here and the one I built and I update, is not trying to predict whether a coin is going to be up in US dollar or down in US dollar, or up in Bitcoin or down in Bitcoin, or up in Euro, down in Euro. It's not doing that in any way, shape, or form. What it's doing, though, is it's saying these coins at the top should beat the coins at the bottom. Which means if the market goes up 1,000%, the coins at the top should have a return of 5,000%, and the ones down below should have a return of 100%. And if the market goes down 50%, the coins at the top of the model should only go down maybe 25% or 10%, or maybe be barely positive, where the coins at the bottom of the model might be down 70% or 80%, or totally go bust and wrecked. That makes sense. And then next question, how often will the data in the Google Doc sheet be updated? Right now, I do it every day. I might miss a day here and there. Luckily, factor exposures don't change that much. The ones we're looking at right now do. Obviously, 1 day return changes every day. But for example, 2 week minus 4 day, that changes every day, but it doesn't dramatically change every day. So even if I miss a day or you miss a day, it doesn't necessarily mean you have to turn over your entire portfolio in a day. In practice, I also do not just daily holding periods, I do weekly holding periods. So for example, today is Monday where I'm at, I update the model, I can buy a bunch of new coins, say 10 different currencies today. Weekly holding period would be basically I go in a coma, I forget about it for 7 days, and I come back. And what would happen? And the results of that would be the daily model, the daily holding period, definitely does better than a weekly holding period, but the weekly holding period still does fantastic. It outperforms. So there's nothing necessarily wrong with holding for a week or missing a day or two. All right, so let me go back to the code here. So the next thing I'm doing here is I'm getting tomorrow's return. So I'm actually doing the opposite. So you could see in line 106, I was sliding it by -1. Here I'm sliding it forward by 1. So I'll run that code. And we don't necessarily see that. Now we have tomorrow's return up there. And then down here, now when people ask like, what skills you need to learn coding, especially mathematical coding, but also any other type of coding, I think 118 or 119 kind of set this up. Now, that doesn't mean anything necessarily, but it's about forward thinking and being creative and knowing where you're trying to go. And in a lot of ways, working backwards. So I knew basically as I was building this, I was going to have a bunch of loops later on, which basically just repeating a bunch of code. So in this case, in 119, I'm basically just creating a copy that I'm going to be using for the loop, later on. But more than anything, I mean, you could go to school and you could be the greatest mathematician or statistician ever, or you can, pass the CFA exams, whatever it might be. If you're going to code, if you're going to model build, you got to have that creativity in you, and you have to kind of see forward and in some ways work backwards. So that's what I'm doing in 118, 119, 122, 123. What I'm doing here is basically called a subset. So basically I'm pulling out only the rows with the date, this part right here, equal to SD. So number SD in this case was 8/26/2018. So that's what I'm doing here. Let's see if this works. My biggest fear here is I might skip a line of code and not run it. So that would screw things up. But let's take a look at all coins now. And that's what we have. So now we still have basically every coin in existence as of today, which is 1786. But all data based upon today, 8/26. And I can scroll down, you'll kind of see them all. And then here, 126, 127, so on, I'm going to be deleting the newer coins. So here again and I'm making just like a copy here with this 127. And then here, 128, what I'm doing is I'm subtracting out the dates. So that's SD, this part right here. Sorry if I'm mumbling a little bit. Right here is I'm just subtracting out dates. So the current date I have right now, and then minus the inception date, which whatever this is. So it'll give me a number of days. Now, when I actually run through the loops, this SD is going to change as I go through every day. So when I eliminate new coins based upon how young they are, it's as of the day that I'm actually testing. So when I go back to 2017, something in the start in January 2017 is going to be booted out in a February 2017 type regression. So here's I'm actually getting the years. So I'll show you that in a sec. And I'll pop this open over here. So you could see as of this 8/26 or 8/28 date, I forget what date I picked. This is the number. This is how long each coin's been around in terms of years at that given point in time. So you have something like number 12, whatever the heck AB chain RTB is. It's only been around 0.08 years. That's too short for me. So I pick that. So how do I do that? Well, I'll get there in a sec. So the first thing I'm doing is I'm just kind of building another data frame. I call it list years. It doesn't really matter what you call it in this case, but it's just slimming down the data frame. Just have some legacy code. And now I'm again, kind of slimming down another data frame. So that altcoins data frame I had before had a ton of columns that I don't really need anymore. So I'm making a new data frame called crypto data, which I'll delete some of these guys for us. So what is crypto data? Same data we had before, but just some of the key variables that we care about. Is everybody following along here? Okay. Got more questions. Okay, somebody said, I don't see a weekly column in your spreadsheet anymore. Yeah, so the reality, I was worried I was overcomplicating the spreadsheet a little bit, so I slimmed it down. There is a high degree of correlation between the daily signal and the weekly signal. So what I did is essentially combine the two. And what I'm doing for the weekly performance is just using that combination signal and saying what would happen if I, held that combination signal for the next week, and for the daily performance, what would happen if I held that combo signal just for the next day. And Jackson asks, is there historical data performance up to now? Yeah, so I run it every day. It goes back to some point in 2015. Then the past month or so has been live. I've been running it every day. So next question, Jackson asks, is there a prediction for how well each coin will perform? So this is, I would say, the next step, which I haven't got to. It's pretty easy code, but there's a methodology that's well beyond the scope here. But at the end, you have what you see on my spreadsheet as alpha or a signal, which is in a ZScore format. Technically, you can convert that to a percent return by multiplying by the volatility of the coin itself, really the predictive volatility. A couple of guys named Grinnell and Quant came up with this methodology ways back. And basically, it's what you do for stock. So you would come up with an expected return, but it's really only meaningful if you want to optimize, so come up with an optimal portfolio. In this model I have here, I'm not actually optimizing, I'm just ranking. So basically saying the top 10 or the bottom 10%, whatever it is. So if I came up with an expected return, it actually wouldn't really change the ranking order of the coins. So it would still be in the same order. So I just didn't necessarily want to overcomplicate it and go down that step, but I could, especially if I wanted to eventually create optimal portfolios by using volatility predictions and correlation predictions, but not quite there yet. But it shouldn't necessarily matter at this point. All right, guys, so let's see where we're at. All right. Okay, so now in 133, I'm merging these two. These two new data frames, crypto data and this list years data frame by name. So basically what this means, for those that don't know R, would be finding common names, name in this case the column name, that's in list years and crypto data, and merging those two together. So if a coin is only in one data frame, say crypto data, but not in the other data frame, then it won't be in this next data frame that I'm building here, which I'm actually naming the exact same as crypto data. So not a big deal. So basically all I'm doing is adding the years to that data frame. And then here is actually where I'm excluding the young coins as of today. So basically I'm saying any coin that has a value of less than 0.3333 in the years column to get rid of, which, as you can see, there's none anymore with values less than 0.333. I got some that are close, like this Aditas in line 26, 0.34, and AdHive, but nothing below 0.33. I think that's very important, like I mentioned before, because you don't want kind of just new exchange pumps or anything like that to kind of screw up your data. And then the next constraint I have is I'm eliminating very illiquid coins. So the way I'm defining this, and again, you can do it however you wish, but the way I'm doing it is looking at the average monthly volume for Bitcoin and compare it to every coin out there. And I'm only including coins that have 0.0001% of the Bitcoin volume. That's pretty small, but Bitcoin has a lot of volume. So I'll kind of show you how that works out. All right. So I ran that code. So here you have volume to BTC over here on the far right. So this is how much volume that coin has. So it's its monthly average volume divided by Bitcoin's monthly average volume, basically. Let's see, there's a lot of very small numbers here. So right now in this data frame, we have 1,347 coins. And once I run this is where I'm actually getting rid of the coins with the very low volume. And now we shrunk down to 228 coins. So this, like I mentioned before, this isn't exactly what I do to a T in my live model that I share with you guys, but it's pretty darn close. So if you look at my model, I generally have 200, 210 type number of coins in my model. So here you have 228. So you can see how it kind of gets narrowed down pretty quick. All right, I know this is boring and quite a bit academic, so hopefully you guys are enjoying yourself, but I think it's important because honestly, quantitative analysis is really where the industry is going. Like I mentioned at the start, BlackRock got rid of basically all their fundamental qualitative guys, and they're going basically all quantitative. And you see a lot of shops doing that. So just kind of understanding how it works, at least on a high level, will certainly at least give you some comfort on what I'm doing, and also various other investment shops out there. So here, what I'm doing, 148 to 152, I'm z-scoring the data. So a z-score, and this is cross-sectional z-score. So I will show you what that means in a second. But a z-score would be the current value minus the average value divided by the standard deviation of your data set. So we're doing this cross-sectionally, which that means, if you remember, I already subsetted the data to today's date. So all the coins are just as of today, right now. I guess in this case, August 26th, whatever date I picked. So as of that date. So what we're doing is trying to z-score across all the coins as of that date. So for line 150, and that's what this scale function is, it's doing that for each coin, taking its one-day return, minusing the average one-day return for all the coins that are still in my data set, divided by the standard deviation of all the coins in the data set. So I'll show you what that looks like in a second. And the reason why we do this is to put all our variables on the same scale, the same unit. So these are in standard deviation units. So here, what I was using with one-day return, a 2-week minus 4-day, they're all in returns. But what if I was using volume as a variable, or market cap, or I mentioned before, Google Trends, all things that are not in return form. So by z-scoring it, we're putting everything on the same scale, and it'll make our regressions a bit better. So let's take a look here. So what I got over here is this new data frame I labeled crypto data z-scores. And it's the same as the old data frame, except now we have some data on the right-hand side. That are the z-scores. So, I'll pick one here. We'll look at Bitcoin here. So that's fantastic. So as of this date, 8.6, Bitcoin's return was a little less than 1%. What does that mean? It's one day Z-score is negative 0.045 standard deviations, which means it actually underperformed the average coin by 0.045 standard deviations, which is pretty much darn close to the average. So basically performed like the average coin. Then you look at something like here, this coin right here, it has a return of 22% the last day. Its one day Z-score is 4.23%. So it outperformed the average coin by 4.23 standard deviations. That's very high. Kind of go down the line, and you can see how they all got Z-scored and scaled. So we're definitely good to go there. So if you have any questions on that, certainly ask. Well, Jax, I don't have a website yet. I'm more of a math guy than a website designer, but maybe I'll make one, one day. But once I end the stream, it'll be on my YouTube channel, so you can come back and check it out. So here, I'm just grabbing another data frame. As you can see, I'm just making a lot of redundant data frames. And this is where kind of math coding, you can be a bit more funky, if you want to use that word, than probably other types of coding, because it doesn't really hurt me to have redundant data frames in terms of space or speed. It's just, for me, it's easier to organize. So I just made this new data frame called Regression Data. So this is all the data I need to run my regression for today. So just one day return, 2 week minus 4 day, and I'm regressing against tomorrow's return. And this is all in Z-score, so the units are all the same for every one of these guys. And that's what I'm doing down here, 157 to 167. I'm actually running that regression. So that's what I'm doing in 158. Regression LM is a linear model. Then you have tomorrow's return against 1 day return and the 2 week minus 4 day. I just want to mention something as well. Like when I scaled the data, Z-scored the data in real life, like my real model, I do a lot more cleaning of the data. Like for example, I remove outliers, things like that. So we saw like a Z-score of like 5 in that data. In my real data, I wouldn't allow an outlier of that scale. I would do a few things, but basically I'd push everything in to between -3 and +3. And then with this linear model, I would do a few more things too. I would weight the regression by market cap, really the square root of market cap. That's kind of the professional way of doing it. The way we're doing it here, it treats all coins the exact same. So basically some illiquid coin that's barely above the 0.0001 mark volume would be treated the same as Bitcoin. In this regression, in my regression, Bitcoin carries a lot more weight. All right, so I will run all this stuff here. Basically, 159 through 166 is just kind of organizing the data and kind of building a table. So we don't necessarily need to get into that. So what is the result here? Regression's payoff day. So here, finally, so what happened on 8/26 in terms of explaining the return on 8/27? So this says that 1 day return had a negative impact on the next day's return. So basically what this says, if you had a positive return, so call it a 1 standard deviation above average 1 day return, this would predict that your return the next day would be negative 0.1 standard deviations below the average return tomorrow. And then here, so that's the reversal effect. That's actually the same direction I would expect in aggregate through time. So high 1 day returns generally mean a negative tomorrow return. The next one is what I'd call momentum. You actually have a negative sign here, which is not what I would expect. But this is something this is why quantitative analysis is powerful. Every day is not the same. I tell people all the time, anything can happen with any coin, any day, any time. And the same with any factor. So when you're looking at day to day, things can go in and out of favor. That's why you need a very robust model to account for this. So in this case, momentum, as defined as 2 weeks minus 4 days, did not work. So the coins that had the most momentum actually underperformed the next day. Interesting. So now we'll actually get to the loop part, and this is where it's clunky. So I'm not going to run the entire loop. I'll get it started to kind of see what it's doing. This is fairly clunky, and it's really the exact same code. Now I'll walk through some of it for the people that care about the nitty gritty of R and kind of learning it. What I'm doing here is I'm doing a repeating loop. So what I'm doing is I'm saying if the start date loop, which I started right here as SD. So if SD loop, which right now is SD, equals the end date, to end the loop, to break it. So it's done in that case. If not, continue on, and this is where I'm going 1 day at a time. So I'm subtracting out 1 day from SD loop and 1 day from RD loop. So for each iteration, I'm going back 1 day in time. And I will go back 1 day in time all the way until I hit ED. That makes sense? So we can run this real fast. And I'm not going to run it all the way through because it'll take a while. And at the end right here in 233 to 241, I'm actually building a table, adding 1 day after the next day. So I'll just show you what it looks like. We'll just run it. So you can see down here, my cursor it has stop. That just means it's running. I'll stop it in a minute. And you kind of get an idea what it looks like. So hopefully everybody's having a good Labor Day if you celebrate that. I'm actually drilling some steaks in a little bit. Okay, Angel asked, do I standardize returns, like doing natural logs and stuff? And the answer is, like in the real thing, yeah, I do certain things like that. And I use like logs, because like things like market cap and volume, they're factors as well. And I take the natural log of those, but I didn't want to get too fancy here. All right, so I will end the loop. It'll take a second. I just hit escape. All right, so it stopped. So we can take a look at this data frame. So regression payoff stay here. So now I'm building this data frame, and this is how I get the data going back forever. So you remember we ran it for 826? Well, the previous day, what happened was actually the opposite. So what worked the previous day on 825 kicked butt the next day on 826, and what had great momentum on 825 did great on 826 as well. But the point here is, I'm building a pretty big data frame going back. We actually only made it a couple weeks, which is why we're not going to sit here and run it, but I will actually pull it up. So I ran this earlier, and I'll show you what it actually looks like once the whole thing runs. But I do it every day. I use databases, CSV files, like I mentioned before. So these loops run, a lot faster. It's just picking up the data, day by day and just looping it much quicker. But I wanted to show this just to give you guys an idea. So I grabbed the data frame I've saved on my drive, and here it goes back all the way to the date we picked, January 28th, 2015. So that loop worked perfect. It ended the day we wanted it to end. So now we have, A lot of people can call these different things. These are, if you talk to a statistician, they would call them like a beta coefficient, or some finance people will call them a payoff. It just depends. So what these numbers just represent, like I mentioned before, is the impact of a one standard deviation exposure of, say, 1 day return to the next day's return. So we got all these. Wow, I still have 10 viewers. That's 10 more than I thought I'd have. Again, that's, I think, what makes the crypto community great. People actually care about some of this stuff. So here is now I'm going to start creating summary stats. So I have whatever that is, 3.5 years of data. So what is that average payoff? So does this factor, the 1 day or the 2 week minus 4 day, does that actually matter? Does that actually lead to outperformance? Yeah, it's not going to be outperformance every single day, but over time, can we rely on those factors to add value? And that's what I'm doing here. So I won't bore you with some of this code. A lot of this is just, managing tables. So I'll run that. And then 263 through 265 is I'm getting what they call the average payoff. So I'm just taking the average of these rows, just going all the way across time. And then 268, I'm taking the standard deviation of those payoffs or betas across time. And 270, 271, I'm counting all the days I have. So I'll run that. And then here, 273 through 275 is I'm actually testing the significance. Now, in practice, I've done a lot more testing, but here I'll just show you guys a basic t-stat. So if you remember in the PowerPoint I showed you guys at the beginning, previous academics would test factors going back to the US stock market 70, 80 years, whatever it might be, and they had t-stats there. Well, a t-stat is basically testing to see if we should be confident that the number, the average payoff, is different than 0. So if it's 0, then obviously there's no impact. If it's negative, then we know we want to basically go short that factor. If it's positive, we want to go long that factor. That's just lingo. I mean, in practice, you can be long both. It's just flipping the signs. But here, you can also think of it as confidence intervals, where you want to be 95% confident or 99% confident that the number is different than 0. So I'll show you what those results are. I haven't really dove into a lot of these results yet, so it'd be interesting to see what they are. So the payoffs full period results, what's this table? So here you go. So over the 1,310 days that we ran those regressions for, the average payoff, the average beta coefficient for the 1 day return is negative 0.08. What that means is, on average, if you have a 1 standard deviation positive outperforming return today, that you should underperform by negative 0.08 standard deviations tomorrow. So that's the definition of reversal. And it's extremely powerful. See that t-stat of almost 11. It doesn't get much more rock solid than that, to be completely honest with you. So that's a pretty great finding. And the same I've seen in my other data. So it's not very surprising. And honestly, if you guys have been following crypto, you see it all the time. You see coins pump 20, 30%, and then they fade over the next day or two. So this basically confirms that hypothesis that we've all seen, that, yeah, it actually literally exists, statistically exists, without a doubt. And we can show it here with a t-stat of almost negative 11. The confidence there is 99.999% that reversal factor exists. About momentum, here defined as 2 weeks minus 4 days. A lot smaller, but it's positive. So there is a momentum effect here where the coins that have been doing well outside of the most recent past continue to do well in the future. The T-stat here is 1.88. That's basically borderline in terms of confidence. In terms of my more robust model, it's a bit higher than that. So it exists, but here it's basically borderline. But either way, now we have a reversal effect and a momentum effect. And that's what I'm doing here. I'm just saving those effects. And I'll jump back to the questions. Okay, we got a few more. Okay, Jackson said, do I utilize bots to trade the market? Not yet, honestly. I might, but if in the top 10%, that's what I like to buy. I would like to have usually 3 to 5, maybe more coins in the top 10% of my model. Well, the reality is, I generally like to trade on certain exchanges. Some of these coins I don't necessarily want to buy based upon exchanges or liquidity. So they kind of get excluded in my own personal bias. And then I do a little basic FA, maybe a little TA too, just to make sure it's a decent entry and nothing crazy is going on. So I don't want to set up like an automatic, buy and then just kind of get screwed by buying something that just a basic analysis would have, picked up. But, generally I use, limit orders, keep it simple. And then, okay, next question, how can we make informed buying decisions? How long can we hold a coin in dark green before deciding it may not perform as expected? Well, personally, I've been running this live for at least a few weeks now. And there's a couple coins I've been holding the whole time. They've done okay. And a couple coins, I buy them, they do fantastic, then I'd sell them. Generally, I like to trust the model. So if it's dark green, I'll just keep holding. But I will make sure there's nothing crazy going on under the hood. The prime example recently would be Ethereum Classic. So if that was dark green or dark red in my model as it was being added to Coinbase, that's where I'd kind of call a personal timeout and say there's something going on outside the model that the numbers don't know. And that's the beauty of FA and quantitative analysis. Why they work well together is the data knows a heck of a lot more than what humans know. As you just saw, we crunched a lot of data really fast, way faster than any human can do it. But humans know data that Quant can't possibly know. For example, Ethereum Classic being added to Coinbase. So Scott, so as a screen, then research FA, then TA. That makes it a bit more formal than what it is. I generally know most of the coins already. And then I kind of have a handful of, I like to buy and sell. So, when I run the model, it does take me more than 5-10 minutes to realize what I want to buy and what I might want to sell. So it's not like a really big deep dive into, FA and TA. For example, as like a TA thing, I might not run the model right away. I might have something to do with, my own life. I can't run it exactly when I get the new daily data. If it's 5-6 hours late, I want to make sure nothing crazy has happened since the data was actually acquired. So that's kind of the basic stuff I do. Okay, next. None of this is investment advice. So this is just, what the model's saying. So what happens if the coin moves from one section to another? So, one test that quants do is they want to make sure that the performance of the model is fairly linear. So say the top 10% beats the top 10 through 20%, which beats the top 20 through 30%, and so on and so forth. And that's exactly what I tested here. You can see it on my spreadsheet as well, where it's not just the top 10% beats the bottom 10%. It's, 25 through 50% beats 50 through 75%. So if a coin goes from 5th percentile to 15th or 25th, I might not automatically sell. It depends if I have something better that I like. Maybe I'll sell, but probably not. If a coin starts dipping into the 30s or 40s, that's where I'd be much more apt to potentially sell, but I'll frankly even still hold. It's just when it gets, at least in my personal bias, when it gets below 50th percentile, that's when I'll be much more likely to sell and flip it into a higher ranked coin. And if a coin falls into the bottom 10% or bottom 25%, it's kind of an automatic sell to me. But I will buy coins that are not in the top 10, that might just be in the top 25%. So I'm not necessarily dogmatic, because I know overall the top 25 will still beat the overall universe. So if it's a coin that I like, that's fairly liquid, I can get in and out pretty quick. If it's 20th percentile, I might buy it. It just depends. Do I have free capital and my opinion on the coin. Okay, yeah, I can use additional benchmarks too. Which, honestly, I could definitely throw Bitcoin on there, but this will definitely beat Bitcoin across pretty much all horizons. All right, so we'll jump back into the model. All right, so what I got now is I got this reversal momentum factor. So here what I'm doing is I'm going to do a back-tested performance for you guys. Now, I'll just be clear, this is in-sample backtesting, fake backtesting, whatever you want to call it. So we're using the data we just acquired, and we're assuming way back in the day we know the information we know today, which is obviously not the case. If you could go in a time machine, you wouldn't know what you know today. So some of this is definitely skewed. Now, the backtest I publish on my spreadsheet is 100% real deal. So, every single day in the backtest on my spreadsheet, it's based upon data that I would only have as of that date. So there's no forward-looking information influencing what I would have done in the past, which is a little different than here. I'm just doing it this way because it's a little bit easier for you guys to follow along. So a lot of this code is actually the exact same that we've been doing. So I'm going to cycle through it pretty quick, but I'm doing the same thing, getting the inception dates, getting the model start dates, getting rid of stable coins, getting the volume, setting up my variables, getting rid of new coins, and z-scoring the data. So in practice, I would be doing a lot of this at the same time as I did the regressions. Here, I just wanted to kind of show you one by one. All right, so I'm running a lot of that code. All right, so that's basically everything we just ran, we've seen before. So what we haven't seen before is this part right here. So I titled it ranks, you can call it alpha, signals, whatever you want. So I will show you the result. But what I'm doing here is I'm taking the z-score of every coin as of any particular date. And here we went back and we're back to August 26th. Taking the z-score for whatever coin, call it Bitcoin, on August 26th for the 1 day return, multiplying it by the reversal average factor score plus the momentum factor score times basically the momentum z-score. And we got that here. So this is what's called alpha, which you can call it a signal. You can call it a lot of different things. In practice, if somebody mentioned if you want an expected return, what you would do from here, you would z-score that column, and then you would multiply and do a few other things, but multiply by the volatility, and you'd end up with return. But we don't need that. If we z-scored it, it would the order would be the exact same. So we don't need to do that here. What I'm doing here is I'm getting the percent rank. So what I'm doing, I'll walk through the code here, is I'm ranking it right here. Breaking ties, things like that. And so ranking it, dividing it by the length of the whole, all the coins basically. And I will show you the results of that. So now this is 0 to 100%. So when I say something's in the top 10%, that's what I'm talking about. So it'd be something that would have a percent rank between 0 and 10%. Now I'm going to build the back test for you guys here. So there's a lot of ways to do it, but I'm doing it this way to kind of walk through and show you guys exactly what I'm doing. So I'm going to write this code right here to basically have it identify which coins are in the top 10% and which coins are in the bottom 10%. So I will do that, show you that. If I'm bouncing around too fast, just let me know. So here we have that. So you have a bunch of NAs, which means it's in neither. But then you have this coin right here. It's in the top 10%. As you can see, the percent rank is 0.02. This guy is in the bottom 10%. Its percent rank is 0.916. So it worked exactly as I would expect. And then here I'm converting that column, because I'm adding new columns, and just changing these ones into returns. So what was tomorrow's return? So this is how these these coins did the next day that were in the top 10 and bottom 10%. Just slowly building that out. And here I'm just subsetting the data to kind of make it cleaner. And down here, and this is pretty simple. So now I just got this data frame of returns for the top 10, returns for the bottom 10. And here I'm just assuming equal weight. So for all the coins in the top 10%, I'm just equal weighting them. And all the coins in the bottom 10%, I'm equal weighting them and seeing what the return was. So that's what I'm doing here. So, and for a 4, I'm just getting what they call the column means, so just the average return. And then down here, I'm just beginning to, for a 5, I'm just subtracting out the difference between the top 10 and bottom 10, so the excess return. For a 6, I'm getting the average return for the entire, what I call the cryptoverse, which is basically all the stocks in my universe. So after I account for the coins that are too young and the coins that are too illiquid, what's the average return? So it's a pretty decent proxy for the crypto market cap. And then I'm just kind of building out my data. So I'll show you what that looks like in a second. All right, let me find it. So this is on August 26th. What was the return? So in this case, the top 10% returned 3.3%. The bottom 10 returned 2.6%. Excess return of a little less than 1%. But they actually both lost to the cryptoverse. That's just one day. So again, when I say it's not going to outperform every single day, that's God's honest truth. That's just the way things work in real life. But the reality is you compound day after day after day, and you end up with a pretty solid return. But I think this model does, even this one, but my real life model does a great job, not only telling you what to buy, but what not to buy. And I'll show you why in a second. Then I have a loop to do all of them. So I will run the loop just to kind of show you how it looks. Maybe I'll answer a couple questions as it's running. If anyone has any questions. Yeah, so in-sample backtesting is bad. So obviously, I'm just doing this just to show you guys. But my spreadsheet is all out of sample. Everything there is completely 100% out of sample. And the results are still fantastic. This just gives you an idea. And the reality, too, if we look at we grab those momentum and reversal factor payoffs or betas, if you want to call it that, they're fairly consistent over time. So, yeah, it might not be the same day in, day out, But if you want to look at like month in, month out, or 3 months versus the next 3 months, you kind of get a pretty similar story where reversals exist and momentum exists. So it makes the in-sample versus out-of-sample performance is actually fairly similar. All right, let me end this loop and I'll show you what it looks like. Take a second. Oh, we don't want that. Almost screwed it up, guys, but I did not. So this is just returns back past couple weeks. Kind of see how, again, it's just looping it, building it out. I'll show you the whole thing, which I will pull up here. We're almost done. Thanks for joining me. I didn't realize this went an hour and a half. That is almost a record for me. So this is all the data. You can actually see I ran it earlier today when I was doing yard work, and you can see 826 is the exact same as we got before, but now we got data going all the way back to May. Again, this is in sample, so you couldn't actually invest this way using this model. You'd have to do some different techniques, which I mentioned I do for the real model. But this gives you an idea. This is all the data going back a few years. So what about results? That's what we have down here, 500 through 509. Basically here, I'm just manipulating a table to make it look halfway decent. Again, just getting row averages and things like that. So let's see if this works. Look at that. Everything worked the way it's supposed to. And here. So this is this model. So the top 10 return, I think we had like 1,300 days or something like that, on average returned 1.5%. The bottom 10 actually lost on average 0.2% per day. So on average, again, the top 10 beat the bottom 10 by 1.8% per day on average. See, the cryptoverse returned about 0.5%. So if we did the excess return there, the top 10% beat the average coin by about 1% per day. 1% per day is a lot, by the way. I mean, that's enormous. If we just annualize those numbers, which is just multiplying it by 365, because crypto is a 24/7 market, you can see this. So the average annual return is 570%. For the top 10, loss of negative 87%. For the bottom 10, et cetera, et cetera. The entire cryptoverse is 174%. What about cumulative returns? So what this would imply, if you just started the model way back in 2015, the first day, and you just invest in the model all throughout time, what would you have in terms of total return? The top 10% return would be a really huge number. I can't even figure out. Looks like a million something percent. I don't know, but a massive number. The bottom 10% would be negative 100%. So this is a very important thing about at least crypto multi-factor models. And the one I publish live every day, it does not only a great job identifying the coins with favorable characteristics, but also coins with bad characteristics. So if you would have just invested in the bottom 10% coins, you would have gone bust in crypto, which is almost amazing given the massive returns in crypto. And this is the case in my model. You can look at the returns on it. You could slice it up by year, by every 3 to 6 months. You would basically go bust in 3 to 6 months, no matter when you'd invest, if you just invest in the bottom 10% coins. So people say coin selection is not that important, don't diversify, all that BS. they're full of it. And if you pick the wrong coins, doesn't matter if you're in a bull market, bear market, neutral market, doesn't matter. You're going to go bust. If you pick the right coins, I mean, you'll get whatever that massive number is. Obviously, you're not going to get that. Past performance doesn't guarantee future results, yada, yada, yada. Not financial advice, but these factor premiums exist in crypto as well. So I believe they would continue to exist. And then you see the actual cryptoverse return here, which is 11,689, which is still fantastic. By far the best returning asset class over the past few years. And that alone is an absolutely fantastic, awesome number. But you can see just having a pretty basic multi-factor model using a pretty basic reversal factor and momentum factor, you can do substantially better than the average coin. Of course, this doesn't account for transaction costs or anything like that. But I think you can also do better, like I mentioned before, if you just layer on just a very, very basic TA and FA. So make sure you're not doing anything crazy. So I think we are basically hitting the end. I will flip it back to I'll just show you actual model returns and we'll be done. Thanks, guys, for joining. Oops. All right, so this is out of sample, live, totally legit, based upon what you would do at that given point in time. So no fake out of sample here. This is just a true out of sample back test. So this is my model that I publish, every day. I'm probably going to tweak it over time. I'm going to add second layer models and I'm going to add factors. So some of this might change, but shouldn't be too much different. Here you see the cryptoverse returns. I believe here I'm going from mid 2015. So it's a little different. But you can see the return is 7,275%. You can see the annual returns 2016, 2017, and 2018. The top 10% here, if you just invest in that every day, just kind of rotated. Again, it's not 100% turnover every day. A lot of the same coins can stay in the top 10 for a week or two at a time. So you just got to keep an eye on it for this. Return here again is something astronomical. You could see 2016 had a return of 1,400. 2017 had a return of 540,000%. In 2018, it's actually positive in USD terms, 26%. Remember, we excluded all the stable coins, so there's none of that hocus pocus going on here. And then what about, I mentioned before, you want to see kind of linear step down. So you see the 10 to 25% underperformed the top 10%, but it still outperformed the 75 to 90% and the bottom 10%. So you can see that as the coin gets rated worse and worse, it does worse. So it's very promising to see. And what I want to identify here too is right here at the bottom 10%, the annual returns. So even in 2016, where the cryptoverse returned 150%, if you invested in the bottom 10%, we would have lost 96%. It would have went bust. 2017, market returned 12,500%. If you invested in the bottom 10%, you would have lost all your money. You would have went bust. In 2018, the market's down quite a bit, and you'd still be bust. So it's critically important to invest in the right coins. A quantitative multi-factor model does a pretty darn good job identifying those. And I think TA has its place in crypto. It's a little outdated for stocks, but crypto, with data being hard to get and various other reasons, it still works fairly well. There's other ways to identify good coins and bad coins, but if you do a bad job at it, you will go bust. It does not matter when. Anyways, guys, I appreciate you joining. I'll see if there's any more questions. If not, we can kind of close this up, and I would appreciate it. All right, so yeah, 1.2 billion % returns. Yeah, looks right. I mean, obviously, once it gets to that point, you can't even invest in that because your account would be so big that you'd have no liquidity. So it's not even really practical. But the point is, it's pretty good. So next question, have I been seeing gains for the last N weeks? So it's been live for basically a month. And the answer is yeah. So the top 10% outperformed in August. It beat the bottom 10% and it beat the cryptoverse. So that was good to see. My own personal investing, I actually outperformed the top 10% by a little bit. Just a few things. Like, for example, I know there's a reversal factor. So, I owned, for example, I think it was IDO during the middle of August. I had one day it went up like 30, 40%. It was in the top 10%. I knew it's going to be hammered by the reversal factor. So I didn't have to necessarily wait until the model told me to do that. So I trimmed at that point. So there's a little nuances where I can add value above and beyond what the model says. But of course, that's a risk in and of itself. And David asked, what resources would I suggest building their own models? Well, yeah, you want to learn R. I think that's a good step. There's a lot of papers out there. If you can DM me on Twitter, and I'll be happy to send you some. But then you can kind of rewind to the first couple pages of this presentation deck. There's a lot of kind of authors there. You can kind of hunt down some of their papers. They're fantastic. So just kind of going through how these guys identified value factors in stocks or momentum factors in currencies or whatever it is. And then you can kind of honestly mimic a lot of what they're doing. Honestly, I think what I'm doing here is a value add, not because I'm doing any revolutionary math or anything different from a quant standpoint. I'm just applying it to a new asset class in crypto. A lot of what I'm doing here, whether it's momentum, reversals, value, it's the same sort of model that I would run for equities. If I could show you my R scripts for my equity models, they would look kind of fairly similar in a lot of respects. So how am I thinking about developing my model further? Well, I think for this one right here, I'm fairly close to done. There's other factors I want to test for this model. So remember, this model would be designed for, you want a portion of your portfolio to be long, whether it's 20, 30, 50%, or even 100%, whatever it is. This portfolio would say, these are the coins that should outperform in your long-only portion of your portfolio. However, I'm also building a model out to be more in and out of Bitcoin. So should you be long Bitcoin, short Bitcoin, or cash or whatever it is? So something a bit more specific. So what I'm ultimately going to do is I'm going to have a portion of my portfolio designated for this model, and then a portion of my portfolio designated for just long-only Bitcoin all the time, because I think you don't want to overcomplicate things. A portion of my portfolio for my in and out Bitcoin model. So I'd imagine the result of that model would be, I'd be able to say Bitcoin has an 80% chance of being positive tomorrow, or a 20% chance of being positive tomorrow, whatever it might be, and maybe some degrees of how strong that signal might be, as in how much it might return. So I think I'm going to turn my attention to that, kind of round out some other models, but certainly there's more work to be done here too. Yeah, I think you can do machine learning here too. It can go a lot of different ways. I think the biggest issue we have here in quantitative crypto analysis is just we don't have that much data. Oh, one of my kids just walked into the room, so I'll probably have to end it pretty soon. But yeah, just the underlying data isn't that robust. So a lot of my factors, a lot of them are return based. I calculate, volatility intervals, things like that. So, as we get more data out there, I think we can get more robust signals. Like, for example, I've been accumulating data on just exchange listings and how many exchanges the coin's on, and when it got added to an exchange. I think things like that, once I get a good data set, potentially have a lot of value, but right now we just don't have that. And once we get more data, I think we can kind of expand out our model selection to even more complex and informative models. Hopefully that answers all the questions, guys. I appreciate you joining for a little over an hour and a half. I think it was great, and certainly, I would love it if you would follow me on Twitter, retweet some of my stuff, subscribe to my YouTube channel, support me however you can. I love crypto; it's a passion. So, I'll be here regardless. But the more people I get to interact with, the more motivated I get. So, it's awesome. Thanks, guys. I appreciate it, and have a great day, evening, morning, depending on where you're at. Take care. Bye.